two words that sound nearly identical when you hear them on television, when you read them in a headline, when a friend repeats them over coffee. But on a tax return, those two words are separated by $1,400, by underpayment penalties, by sleepless nights, staring at a bill you cannot cover. The first word is elimination. The second word is deduction. Last year, the government promised one, the law delivered the other. And right now, millions of American seniors who heard the promise but never read the law are discovering the difference in the worst possible way. Through an envelope from the Internal Revenue Service demanding money they do not have for taxes they were told no longer existed. The Social Security Administration itself caused part of this disaster. In July of 2025, the agency sent an official email to millions of beneficiaries stating that federal income taxes on Social Security benefits were being eliminated under the new legislation. That email was factually incorrect. The agency published a quiet correction on their website weeks later. They did not send a second email. They did not call anyone. They did not issue a notification. Millions of people who trusted that original message removed their tax withholding entirely and spent 12 months believing they owed nothing. Those 12 months of zero withholding are now arriving as a concentrated lump sum tax bill, plus an underpayment penalty that grows with every month the shortage existed. If you removed your withholding last year based on anything you read, heard, or received about Social Security no longer being taxed, this video may be the single most financially important thing you watch this year. And if you have not yet made any changes but are considering it based on what you believe the new law does, stop. Do not touch your withholding until you understand exactly what happened, exactly what the law actually says, and exactly how much money you personally will or will not owe when you file. Every number I present comes from IRS Factsheet FS 2025-03, from the Social Security Administration's own corrected statement, from the text of Public Law 119-21, and from AARP's independent published analysis. The damage this confusion inflicts on real households becomes clear through a couple in Ohio whose experience is being replicated in tens of thousands of homes simultaneously. Robert is 67. His wife Linda is 68. Robert receives the current national average Social Security benefit of $2,071 per month, confirmed at ssa.gov/news/en/cola/factsheets/2026.html. Linda receives $1,500 monthly. Their combined annual Social Security is approximately $42,852. Robert also has a small pension paying $14,000 per year and takes required minimum distributions from his traditional IRA of about $12,000 annually. Their total household income is roughly $68,852. When Robert received the SSA's July email stating that the one big, beautiful bill eliminated taxes on Social Security for most beneficiaries, he logged into his account that evening and removed all voluntary withholding. For 12 consecutive months, he believed no taxes were owed on his benefits. The corrected statement published at ssa.gov/news/press/releases/2025/never reached him through any channel he actively monitors. Now filing his 2025 return, Robert discovers his provisional income, calculated as his adjusted gross income of $26,000 from pension, an IRA plus half his Social Security, equaling $21,426, totals approximately $47,426. That exceeds the $32,000 married filing jointly threshold, making up to 85% of their benefits, subject to federal tax. The new deduction helps reduce Robert's liability. It does not erase it. He owes over $1,400 he never planned for, plus penalties for 12 months of zero withholding. His medication budget, his property tax payment, and his auto insurance renewal are now competing for money that a single incorrect government email removed from his awareness. Here is what the law actually created versus what people believe it created. Public Law 119-21, the One Big Beautiful Bill Act, established the enhanced deduction for seniors. It provides an additional tax deduction of up to $6,000 per eligible individual, or $12,000 for a married couple filing jointly, where both are 60, 65, or older. One qualifying spouse yields $6,000 for the couple, documented at irs.gov/newsroom/1-big-beautiful-bill-act-tax-deductions-for working dash, Americans dash, and dash seniors. This deduction is temporary, covering tax years 2025 through 2028 only. It ceases to exist after 2028 without new congressional action. Eligibility requires being 65 by December 31st of the tax year, including your Social Security number, and filing jointly if married. Phase-out begins at 75,000 MAGI for single filers and 150,000 for joint. It shrinks 6 cents per dollar above those thresholds, disappearing entirely at 175,000 single or 250,000 joint. Verify at irs.gov/newsroom/check-. Your dash eligibility dash for dash, the dash new dash enhanced dash, deduction dash for dash seniors. The deduction stacks on existing deductions regardless of itemizing. A single filer 65 or older has 15,750 standard deduction, 2,000 existing senior addition, and 6,000 new, totaling 23,750. A joint couple, both 65 or older, has 31,500 standard, 3,200 existing senior combined, and 12,000 new, totaling 46,700. Confirmed at irs.gov/newsroom/2026-filing-season-updates-and-resources-for-seniors. The formula that actually determines whether your Social Security is taxable has been unchanged since 1983, and this law did not touch it. Provisional income equals adjusted gross income, plus tax-exempt interest, plus half your annual benefits. Exceeding 25,000 single or 32,000 joint makes up to 50% of benefits taxable. Exceeding 34,000 single or 44,000 joint makes up to 85% taxable. These thresholds have never been inflation adjusted. If indexed, they would be approximately 78,000 and 100,000 today. Confirmed at ssa.gov/FAQ/question/KA-02471.html with a calculator at irs.gov/help/ita/r-social-security-retirement-tier-I-benefits-taxable. The new deduction operates downstream. From this calculation, it reduces total taxable income after the taxable portion of benefits has already been determined. For very low-income seniors, it may zero out the bill. For anyone with moderate income from multiple sources, benefits remain partially taxable. AARP confirms at aarp.org/money/taxes/what-to-no-new-tax-law-2025/. 6 traps are destroying financial plans across the country right now. First, believing Social Security is tax-free. No provision in the law eliminates benefit taxation. The SSA email was wrong and corrected. Reinstate withholding immediately if you removed it. Second, assuming you receive the full deduction regardless of income. Phase-out begins at 75,000 single or 150,000 joint. Many seniors with pension plus RMDs plus half their benefits exceed these levels without mentally combining the streams. Third, thinking you qualify at 62 or 63. Requirement is 65 by December 31st, excluding early retirees and most SSDI recipients under that age. Fourth, believing the deduction reduces Medicare premiums. IRMAA uses MAGI from 2 years prior, and this below-the-line deduction likely does not lower MAGI. The 2026 Part B premium is $202.90 with surcharges beginning at $109,000 for single filers per aarp.org/Medicare/Medicare- Part-B-premium-increase-2026/. Fifth, assuming permanence. This benefit expires after 2028. Planning your entire tax strategy around a 4-year provision without addressing year 5 creates a cliff you will fall off without warning. Sixth, frozen thresholds. Every COLA pushes benefits higher while the 1983 lines remain immovable. The 2026 COLA of 2.8% added $56 monthly or $672 annually to average benefits, dragging more income above the invisible line each year per aarp.org/social-security/things-to- no-about-taxes/ There is a systemic consequence few people connect to their personal situation. Taxes collected on Social Security benefits do not flow into general revenue. They flow directly into the Social Security trust funds. In 2024, that amount was $55.1 billion, roughly 4% of total program income. This deduction reduces seniors' taxable income, which reduces tax collected on benefits, which reduces trust fund revenue. Analysis suggests this moves the OASI trust fund's projected depletion approximately 1 year earlier, from 2033 to the fourth quarter of 2032. After depletion, benefits face an automatic reduction of 17 to 22% for every recipient unless Congress passes solvency legislation before that date. Full analysis at aarp.org/social-security/fund-report-2026/. You should absolutely claim every dollar this deduction entitles you to. But understanding that the short-term tax savings contribute to a long-term funding shortfall allows you to plan beyond the 4-year window. With eyes open rather than being caught by two converging shocks, the deduction's expiration and the fund's depletion, arriving within years of each other. Your 3-step action plan begins this week. Step 1 is determining whether your Social Security benefits are currently taxable and aligning your withholding with reality. Go to the IRS Interactive Tax Assistant at irs.gov/help/ita/r-my-social-security-retirement-tier-i-benefits-taxable and enter your actual income figures. Then use the tax withholding estimator at apps.irs.gov/app/tax-withholding-estimator to project your full year liability. If you owe taxes on your benefits, set up voluntary withholding immediately at 7, 10, 12, or 22% through your My Social Security account online or by submitting Form W4V to the Social Security Administration. Instructions are at ssa.gov/manage-benefits/request-withhold-taxes. Establishing withholding now distributes the obligation across your remaining monthly payments, rather than concentrating it into a single, devastating bill next April that you have no reserves to cover. If you set your withholding to 0 last year because of the incorrect email, restore it this week. Every additional month at 0 adds to a balance that compounds through penalties into a larger problem than it needs to be. Step 2 is calculating your personal deduction amount using real numbers from your specific situation, rather than a headline figure that may not apply to you. Total every income source for the full tax year. Social Security benefits, pension payments, traditional IRA, and 401k required minimum distributions, part-time wages, rental income, investment dividends, realized capital gains, annuity distributions, and any other taxable amount. If filing jointly, combine both spouses. Determine your total modified adjusted gross income. If it falls below $75,000 as a single filer or $150,000 filing jointly, you receive the full deduction. If it exceeds those thresholds, multiply the excess by 0.06 to calculate how much your deduction is reduced. Subtract that number from the maximum to find your actual deduction. Write that precise figure down. Use it in your planning. Do not budget using $6,000 or $12,000 from a headline without confirming it applies to your income level. The IRS tool at irs.gov/newsroom/check-. Your dash eligibility dash for dash. The dash new dash enhanced dash deduction. Dash for dash seniors helps verify. Many seniors discover their actual deduction is substantially smaller than expected once all income streams are honestly combined, particularly those receiving pensions alongside required minimum distributions from retirement accounts built during higher earning years. Step 3 is converting this temporary 4-year window into a permanent strategic advantage, rather than passively collecting a slightly lower tax bill. Your combined standard deduction between 2025 and 2028 is significantly larger than at any point in recent history. That creates meaningful tax-free space in your return that did not previously exist. If you hold assets in a traditional IRA that will eventually be forced out through required minimum distributions at escalating rates as you age, consider converting a calculated portion to a Roth IRA each year during this window, while the elevated deduction absorbs part of the taxable conversion event. Roth conversions permanently eliminate future required minimum distributions on the converted amount, remove all future taxation on those funds and their growth, and can help you remain below IRMAA thresholds in later years when the deduction expires and your base taxable income rises back to its pre-deduction level. This strategy is discussed extensively by tax professionals, and at aarp.org/money/taxes/what-to-know-new-tax-law-2025/. Overconverting in a single year can push you into a higher marginal bracket or trigger Medicare premium surcharges for 2 years following, so precision matters greatly. Model multiple scenarios, or engage a qualified professional who can calculate optimal annual conversion amounts for your specific tax picture, health situation, and longevity expectations. If private tax assistance exceeds your budget, 2 free programs exist specifically for seniors. The IRS Volunteer Income Tax Assistance and Tax Counseling for the Elderly programs serve qualifying individuals at no cost. Call 800-9069-887 or find a site at freetaxassistance.irs.gov. AARP Foundation Tax Aid provides identical free preparation at thousands of locations nationwide. Call 888-227-7669 or visit airp.org/money/taxes/AIRP-taxaid/. Both programs employ trained volunteers who understand the new deduction, the provisional income formula, Roth conversion implications, and how all three interact for seniors with multiple income sources. Here is the complete picture assembled into a single frame. The enhanced deduction for seniors is genuine legislation that will reduce tax bills for millions of Americans over 65 across 4 filing seasons. It is real money. It is worth claiming. But it did not eliminate taxation of Social Security benefits. It did not repeal or modify the 1983 provisional income formula. It does not reduce modified adjusted gross income for Medicare premium calculation purposes. It expires without ceremony after the 2028 tax year. And it quietly drains revenue from the trust fund, whose approaching depletion already threatens a 22% benefit cut for every recipient within 6 years. The seniors who will navigate this period with their finances intact are those who understand precisely what the deduction is and is not, who calculate their exact personal amount rather than trusting a number from a headline or a retracted email, who maintain withholding calibrated to their actual liability throughout all 4 years, who strategically convert traditional retirement assets to Roth during the elevated deduction window to improve their position permanently, and who plan explicitly for 2029 when the deduction vanishes and their taxable income reverts to its previous higher level. That combination of accurate understanding and deliberate action is the difference between using this 4-year window as a wealth-building opportunity and stumbling through it based on misinformation that creates a new financial crisis every April. Share this video today with every person you know who is 65 or older, who collects Social Security, or who is approaching retirement within 5 years. Send it to your spouse, your parents, your siblings, your neighbors, your coworkers counting down to their last day, and your friends at every gathering where retirement is discussed. The people most at risk from this confusion are those who received the original government email last July, trusted it as any reasonable person would trust an official communication from SSA.gov, and never encountered the buried correction that appeared without notification. They deserve the truth while there is still time to fix their withholding, before another filing deadline arrives with a bill attached. Click the link in the description below and join the Global Senior Alerts official WhatsApp channel. Upon joining, you receive a free Senior Benefits Protection Guide containing a complete worksheet for calculating your exact deduction based on your specific income, a step-by-step method for determining whether and at what percentage your benefits are taxable, every form number and official URL referenced in this video, a Roth conversion planning template designed specifically for the 4-year elevated deduction window, and a trust fund timeline connecting the short-term opportunity to the longer-term systemic risk. Every week, the channel delivers verified updates drawn from SSA.gov, IRS.gov, AARP, and the Federal Register so that no correction, no deadline, no threshold adjustment, and no new rule affecting your income or healthcare ever reaches you after the damage rather than before. This guide and these weekly alerts are completely free because Americans who contributed to this system for their entire working lives deserve straightforward information delivered in time to act on it. Join through the link below, subscribe to this channel so every future update reaches your feed without searching. Turn on your notification bell so time-sensitive deadlines never pass unnoticed. And leave a comment telling me whether you removed your withholding last year or caught the correction before making changes. I read every comment and will direct you toward the specific tools and steps matching your situation. Trust numbers over promises. Calculate before you change anything. And make absolutely certain every person you care about sees this before the next filing season transforms confusion into a bill they cannot pay. This video is for educational and informational purposes only. It does not constitute legal, financial, or tax advice. Consult a qualified tax professional for guidance specific to your individual circumstances. All data cited comes from official sources, including SSA.gov, IRS.gov, AARP.org, and the text of Public Law 119-21. The Retirement Desk